Thanks, Tim. Thanks for the opportunity to present today. I'm Kim Lindsay, CEO of Lindsay Australia. Presenting with me today is Justin Green, our CFO, and Matt Heffron, our group analyst. I'll give you a brief overview of the business, then I'll hand over to Justin to discuss our recent results and financials. Skip to slide 3, please, Tim. Lindsay Australia was founded in 1953 as a small transport operator in Coffs Harbour. Today, the business turns over more than 400 million revenue as a fully integrated logistic business, providing a unique end-to-end solution for over 3,000 customers who are primarily in the horticultural industry. Lindsay has 3 companies in our divisions: Lindsay Transport, which operates one of the largest refrigerated fleets in Australia; Lindsay Rural, one of the largest independent rural merchandise business in the country; and Lindsay Fresh Logistics, a logistics specialist in the Brisbane markets who focuses on imports and exports. By combining the divisions, we can offer our customers a unique end-to-end solution with the ability to help grow their produce, as well as package, transport, and distribution through their products throughout Australia and the world. Transport is Lindsay's largest division, accounting for 70% of the group's revenue. For nearly 70 years, Transport has been a road-only operator, but in 2015, we diversified our services, purchasing our first refrigerated rail container. Rail now makes up 20% of the division's revenue. Slide 4, please, Tim. Lindsay has over 40 transport depots and rural stores across the country, primarily servicing the East Coast. Most transport depots are unique with specialised cold rooms. Our network reaches from Perth in Western Australia to Mareeba in far north Queensland and can be found in most major growing regions across the country. Slide 5, please, Tim. Lindsay has been public listed since 2002 with a market cap of 108 million at the last close. Many of our shareholders have been supporting us for several years, which is why we are committed to giving back to them. Lindsay has a strong track record of paying dividends with a yield of around 5 to 6% in recent years. I'll now hand over to Justin. Thank you.
Thanks, Kim. Thanks, Tim, and everybody for the opportunity to present the Lindsay story today. I'll touch base on the group's financial performance and cover off some key points from each of our divisions. For the half year ended December, the group experienced some flat revenue growth, but despite the flat revenue, we had some material improvements in our underlying margins. So the improvements in the margin flowed through to deliver a record half year EBITDA and strong double-digit performance across a number of our other financial metrics. And importantly, the half year, despite some of the challenging environments throughout COVID, delivered us a fairly strong balance sheet with a significant amount of cash. As a result of the strong performance, it was pleasing that we were able to increase our half year dividend by 20% to 1.2 cents per share. And this is next slide. Thanks, Tim. This is the 3rd consecutive year now that the group's experienced a material increase in our half year EBITDA. And I think that shows that the strategy that we implemented 3 years ago with our rail is starting to pay dividends. Importantly, this result was supported by the strong performance, not only by Transport and Rural, but some reduction in our corporate overhead costs as well. Our focus remains on the balance sheet, and we focused on the balance sheet to put us in a position that we can take advantage of opportunities in the coming years when they arise. A number of the key metrics are included on your slide 7. The group continues to invest for the future. In the past 3 years, we've invested close to $90 million on new equipment and expanding our major refrigerated facilities. Our CapEx strategy is relatively simple: safety and to deliver shareholder returns. We operate a relatively simple growth philosophy: expand rail, expand rural, and renew our road fleet. The debt profile is pretty typical of our logistics business in that almost 80% of our debt is made up of individual equipment finance leases for trucks, trailers, and refrigerated containers. We operate a small amount of corporate debt, and that corporate debt's used primarily to fund freehold facilities and the fit out of some of our major refrigerated facilities. Next slide, thanks, Tim. I'll touch briefly on each of the divisions. Transport is the largest, as Kim mentioned, of our division. Annually, we have approximately 300 million in turnovers from this division. For the half year, Transport delivered a very strong result and was supported by the organic growth that we're achieving in our rail strategy. Transport operates an extensive network, not only in the horticultural areas, but in all our major capital cities. Transport operates close to 300 interstate prime movers, and we have 700 trailers, primarily refrigerated, in the fleet. In 2015, we started our rail strategy, at which time we had 0 refrigerated rail containers in our fleet. That half year just completed, we had 231 refrigerated containers owned, and we also operated a number of hire containers due to the delays in some of the importing of the new equipment. By June 2022, our focus is to increase that rail container fleet to almost 400. But although the rail remains a key organic growth strategy for the group, it's complementary to our road strategy. What we'll find is it gives us an opportunity now for tenders. Previously, before 2015, we would have large supermarket chain tenders, and as we didn't operate a rail service, we were only tendering on the road service. Now, as a fully integrated logistics business, we can operate both road and rail and provide unique service offering to our customers, in that if either one of those services are out for whatever reason, whether that be fire, flood, cyclones, or potentially train derailments, we can offer that unique service, and that we can still move their time critical freight. Customers are loving it. It gives us a strategic advantage when we're in these tenders. We can offer the lower cost, and traditionally rail is a lower cost model for the customers, but we can supplement that with the high service model of the road fleet. And we will continue to expand that rail to help us diversify some of our seasonality risk that comes with the horticultural business. Next slide, thanks, Tim. Lindsay Rural is probably the unsung hero in the group. Kim started the Lindsay Rural business almost 40 years ago. It operates as one of the largest independent resellers and a direct competitor to the majors, which is Elders and Nutrien. Lindsay Rural is not aligned to any buying group. They source their product directly from overseas and from all the major chemical companies and all the major fertiliser companies. Lindsay Rural turns over approximately 130 million annually. And our philosophy is to offer a high service model to the small to medium range customers that value that service model. The advantage for Lindsay Rural is that no other rural merchandising business has a transport company, has a logistics division the size of Lindsay Transport, which puts us in a unique position where our speed to service for these customers is unmatched by any other competitor. Over the last 3 years, we've been on a bit of a journey for Lindsay Rural, and we've basically gone, we call the model back to basics. We want to reduce our costs to serve the customers. We're increasing our sales team. We focus on high growth horticultural regions where we've been underrepresented, and we're increasing our share of wallet for each of the customers. We're going to continue to expand this model over the coming years, and in the last 2 months, we've recently opened a new branch at Woolgoolga in New South Wales, which also complements our transport operations in that area. Next slide, thanks, Tim. Lindsay Fresh, as Kim mentioned, based in Brisbane and specialises in import and export logistics. But more importantly, for Lindsay Fresh, it offers a much more vast range of services. Lindsay Fresh is a one-stop shop for import, export, and all the requirements, whether that be fumigation, cold chain, labelling for all our customers. Now, Fresh also complements the transport operations, giving our customers a single point of contact to get their produce from farm to wherever that produce is going, whether that be intrastate, interstate, or international. I appreciate the time to present. I'll hand back to Kim now to talk about the group's growth strategy and our outlook.
Thanks, Justin. Our growth strategy, as we touched on throughout the presentation, our current strategy is relatively simple: continue to grow transport by expanding the rail fleet and also upgrading facilities that are operating at capacity. Rural will continue to elevate new low-cost retail models in key porty areas, while Fresh will continue to benefit from the recovery of import and export markets. The outlook overall, Tim, the next slide. Overall, our outlook for the business is positive. We expect to maintain our half-year EBITDA guidance of 12% growth on the previous year. The business balance sheet remains strong and will allow us to continue to grow and return value back to our shareholders. We have a proven track record on embracing and overcoming challenges. I'd just like to thank you for your time and any Q&A. Thank you.
Thanks, Kim. And you just mentioned challenges. What's the environment been like lately with, we've had COVID to start, COVID now and floods previously. Can you talk to how you adapt in those sort of environments?
COVID was very challenging. Yeah, we had March, April, May, June last year that we had 3 to 4 months where the business was absolutely turned upside down to where we were in there. The freight volumes were very strong out of the capital cities. The produce wasn't running strong at that time. We managed to work our way through that. We got into July before we really got back to some kind of normality. The challenges at the moment is finding staff. Very hard to find staff out there at the moment. We're finding our Horty guys are having the same issue finding pickers. We're very lucky. The Horty prices are great prices at the moment, so it's compensating for some of the volume not going out. But if we had a challenge going forward, is really about labour.
And you've attracted some significant shareholders. You showed on a slide there. You've got Soul Patterson's, you've got Milton, BKI Investments. I think that's the old Brickworks. What's your policy? I mean, they're value investors. What's your policy around dividend growth for investors?
Look, we look at paying 60 to 70% out every year across the board, and we'll stay to that as we grow through the business, as we get more profitable. But having shareholders like the Souls, BKI, Milton Group, they've been with us since the day we floated. They're very strong. Get behind the business, and we're probably very privileged to have them as shareholders.
Certainly are. And so can you talk us through what's your view as sustainable in terms of your long-term revenue mix between road, rail and rural?
Yeah, look, our rail business is growing at double digit every year at the moment, and we see that continuing going there. And why have we gone rail? If you have a look at the average truck driver age at the moment, is 59 years of age across the industry. It's very high, and we see that if we don't change now, and what we have been doing the last 3 years across the board, we'll get to another 3 or 4 years, and we'll have an age of truck drivers, when they're 63, 64, starting to retire, we won't be able to move the volume of freight. We're back to back with Pacific National. They're a good company to deal with. We want those double-digit growth to keep going that way. And to give you some idea, last year we did mangoes out of Mareeba, which is above Cairns, into Perth by rail. At 7.5 days, absolutely turned up fantastic. We've built the rail containers coming out of China. We fit them out here. They're as good as any refrigerated trailer we've got running around Australia. We've got live chickens, I should say fresh chickens, going to Perth out of Adelaide, and we've got prongs in the chickens so our customers can see the temperature of our chooks as they're going across the Nullarbor. So the technology is quite amazing today, the money we've spent to do this.
Anything I'll add to that, Tim, is 5 years ago, if you tried to move produce on rail, you wouldn't have a customer. They would never deal with you again. Now what the time is if you don't have that rail offer, it's going to hold you back in the future. So we've probably been leaders in that area. We treat rail containers no different to how we treat our road fleet. Optimal utilisation rates. So having trucks sitting down or containers sitting down, we treat them no different. So if you don't have that rail offer in coming years, and as Kim mentioned, there's challenges with capital city congestion. There's challenges with driver shortages. There's challenges with just the road network that we're operating on. If you don't have that rail option in the coming years, you're going to struggle to be a key competitor in the sector.
And just the last question, if you don't mind. So what's kind of coverage of the Australian market do you plan to have in the next couple of years?
In the hoarding industry, we're one of the largest in the hoarding industry, but across the whole Australian market, we wouldn't be 2% of the market.
Yeah. So there's plans to grow that?
There's a lot of opportunity to grow, but we're just not going to grow for revenue.